Disney has been challenging Netflix for the streaming crown. However, with the latest switch at the top, it seems that not everything is all roses with the Disney company. Let's find out what is going on and if Disney is set to become the undisputed king of streaming. Since we are discussing the whole Disney company in this video and want to find out if the company is a good investment for us, we'll firstly have an overview of the company as a whole and then zoom in on the streaming side to make our final conclusion. Afterwards, we'll look into the earnings of the company, discuss the management shift, and have a brief look at the chart pattern before making our conclusion. This year will mark the 100th birthday of the Walt Disney Company, a milestone a company very rarely manages to achieve. In fact, only 0.01% of companies worldwide reach this milestone. We'll not go into the history of this company, but with a heritage as big as Disney, it's hard to bet against this company over a long period of time. Let's first see where Disney gets its revenue from. In Q1 2021, Disney reorganized its reporting business segments. The company now operates through two main business segments: Disney Media and Entertainment Distribution and Disney Parks, Experiences and Products. The first of these segments, which is composed of Disney's Media and Entertainment business, is further separated into three components: linear networks, direct-to-consumer, and content sales, licensing and other. The second segment is Disney's Parks, Experiences and Products. This segment includes the Disney theme parks, resort hotels, water parks, dining, conference centers and other recreational facilities. In 2020, the United States' Magic Kingdom was visited by nearly 7 million people, making it the most visited amusement park worldwide. This segment also runs the Disney Cruise Lines and Vacation Club. Revenue is generated through admission fees to theme parks, payments of cruise vacations, sales of food and merchandise, and fees from hotel rooms. The Parks, Experiences and Products segment reported revenue of $28.7 billion in 2022, rising 24% year over year. The segment posted an operational income of $7.9 billion, a significant improvement from the operating income of $471 million in 2021. The segment accounts for about 28% of Disney's total revenue and about 48% of its total operating income. This segment accounts for Disney's various cable networks such as ESPN, ABC Family, and Disney Channels. The company also owns television production operators, television distribution, and radio networks, and a 50% equity investment in A&I television networks. Revenue within this media network segment are generated through advertising fees, affiliate fees, charged to their various media services, and the sale and distribution of television programming. The linear network segment posted revenue of $28.3 billion in 2022, only slightly higher than revenue a year ago. Operating income was $8.5 billion. The segment accounts for 33% of total revenue and 52% of its total operating income. Disney's direct-to-consumer segment is composed of its various streaming services, including Disney+, Disney Plus Hotstar, ESPN+, Hulu, and Star+. The direct-to-consumer segment posted revenue of $19.5 billion in 2022, up 20% from 2021. The segment reported an operational loss of $1 billion, widening from the operational loss of $892 million reported a year ago. The direct-to-consumer segment accounts for 23% of its total revenue. Disney's content sales, licensing and other segments sell film and television content to third-party TV and subscription video on-demand services. The segment also includes the following operations: theatrical distribution, home entertainment distribution such as DVD and Blu-ray, music distribution, staging and licensing of live entertainment events on Broadway and around the world, post-production services through Industrial Light and Magic and Skywalker Sound, and a 30% ownership interest in Tata Sky, an India-based operator for a direct-to-home satellite distribution platform. The content sales, licensing and other segment posted revenue of $8.1 billion in 2022, up 11% from the year-ago quarter. The segment reported an operational loss of $287 million, a significant deterioration from operating income of $567 million from the year before. The content sales, licensing and other segment accounts for 10% of its total revenue. Now that we had this overview of the Disney company and where it makes the bulk of its money, we can see that it basically only has 2 profitable divisions, with parks and so forth bringing in a total of 48% of its operating income and linear networks the other 52%. When Disney first announced its Disney Plus offering in late 2018, it probably didn't think that its timing was so perfect. Launched in late 2019, just in time for the great pandemic hit the world. Its subscriber counts rocketed like there was no tomorrow. Disney predicted subscribers would grow to between 60 to 90 million by 2024. Disney Plus has however quickly surpassed those numbers, reaching the 95 million mark in January 2021. It then revised its streaming aspirations, shooting for 350 million subscribers by 2024 across all its major streaming platforms. As of Q4 2022, Disney has 235.7 million subscribers in total, comprising of 164.2 million Disney Plus members, 24.3 million ESPN Plus members, and 47.2 million Hulu members, making the total number of subscribers higher than that of Netflix's 223 million. Now, if we just look at these raw numbers, we conclude that just by member count, Disney has passed its rival Netflix in just 3 years' time. However, investors are not that excited about these numbers as you might think. Disney has issued a warning that it expects revenue growth to slow down, as already been seen in the last couple of quarters, and expects to reach somewhere between 230 to 260 million subscribers by 2024 with its Disney Plus offering alone. This spooked investors as they were hoping for some bigger growth numbers. But to me, this isn't the biggest concern, since it's already a mature business in its size. For me, the biggest concern about the direct-to-consumer branch that entails all its streaming services is the profitability. The streaming side of Disney has never made any profit, and they are hoping to become profitable by 2024. If you compare this with Netflix, that is turning out profit year over year, with its streaming services and growing that profit year after year, Disney has a lot of catching up to do. Of course, Disney has the advantage that any interest in their streaming services spills over into their park and products revenue. So just looking at their business to make a profit might not be fair. However, it is clear that investors want to see this turn a profit sooner rather than later. And I think it's very well feasible that in 2024 or 2025 this will happen. Not only just by growing the numbers of subscribers and driving down costs, but also by hiking the subscription price, which they will inevitably do. This brings us to the shift in CEO at Disney. Enter Mr. Bob Iger. Bob Iger replaced Bob Chapek after the board of Disney was disappointed with his performance, both on the earnings side and with the public attack on Scarlett Johansson over Black Widow and the late response to the Don't Say Gay law in Florida. Bob Iger has proven in the past that he can get the results Disney wants and has been a trusty helmsman in the previous stint. Already has made an impact, vowing to bringing back control of the company to the creatives instead of the accountants. In order to spur this creativity, he has ordered the Disney staff they have to be in the office 4 days a week. Bob Iger will have his focus set on continuing the growth of the streaming services and bringing profitability back on the table. That if activist investor Nelson Peltz doesn't get in the way. Disney has a healthy balance sheet with $13 billion in cash. The earnings show a steady growth year over year, and now that everything is opening up again, and if the streaming services can keep growing as they expect, this will only continue. Profitability has been on a lot of pressure during the pandemic. However, I do believe it's inevitable they will go back to pre-pandemic figures, and with higher revenue numbers, they will be able to bring in better figures than ever before. When we look at the charts, we see that in the short term there is a bit of an uptrend. However, the overall trend is still down and we haven't broken out of any major resistance levels yet. So I wouldn't be surprised if we go back down again in the next couple of weeks. Of course, as always, much will depend on the earnings, but those are not yet out for another month. So it would be careful if you are thinking of buying shares at this level. Disney has dethroned Netflix if you just look at the raw number of subscribers. However, its streaming service is far from making money and still has a lot of work cut out to be on the same profit level of Netflix. However, I do believe that streaming can become a profitable business for Disney going forward. This combined with their other divisions who are set to get back to pre-pandemic profitability and under the leadership of Bob Iger, I believe that with a current market cap of $175 billion, Disney is not a bad investment to have right now. However, if you think it won't be taking the crown of Netflix, then maybe this video is for you. Also, if you enjoyed this video, please consider leaving a like and a subscribe. See ya!